Well, good day, traders. Chris Weston here, Head of Research at Pepperstone. We're going to once again go into a little bit of a deep dive into what's going on in financial markets, specifically equities today. And if we really hone in and we're focused on what's happening in the Australian market, that's where we're seeing most of the flow. Most of the questions have been around this idea that we've breached 7,000. Can this continue? It doesn't feel right buying at these levels, valuation-wise. We've never been this high, 18.3 times forward earnings. It's been all multiple expansion. It's been all trend. It's been all FOMO buyers coming through, but we do seem to be holding that level. You know, if you look at price action today, we've broken through 7,000. We've taken out that top end of the multi-year channel. People were saying this is a natural level to fade. We can't hold this 7,000, but at this stage, at what I'm seeing right here, right now, the market is holding it. We're seeing those high growth, high PE names. What worked in 2019 is working in 2020. Healthcare looks absolutely breathtaking. We're looking for CSL to try and break through that $300 mark. You know, healthcare is working well, comm services is doing well, IT is working pretty well. Discretionary is interesting. If you look at the rates market at the moment, you know, what are you getting? You're seeing a situation where people are seeing on balance that we are going to see the Reserve Bank cut rates in that February meeting. The market's pricing that at 54%. So it's a line ball call, but I think people are saying if we go down to 50 basis points in the cash rate, it pretty makes much sense that in a number of months that we're probably going to go down to 25. Perhaps then we can really start taking out QE. The RBA have told us that they want to do QE at 25 basis points or start looking at it much more closely, start talking that up. And I think you may be starting to see that being front run certainly in the equity markets there as well, with discretionary doing so well. We haven't necessarily seen that play through in the Aussie dollar. The Aussie dollar's been held up probably because there's been a nice bid in emerging market FX. But if we were really starting to price in QE, you would be seeing the Aussie dollar moving sharply lower or progressively lower on a trade weighted basis. That isn't happening yet. In fact, if you look at the fixed income market, there's been a heavy bid in the recent government bond auctions. They've been heavily oversubscribed, and one suspects that could be a sense that people are pre-positioning for quantitative easing, although quantitative easing in the US actually saw Treasury yields moving higher, which I think is an interesting concept. But we're holding those levels at the moment. It doesn't feel right buying this, but what worked in 2019 works in 2020 at the moment, and this concerted move. In fact, if you look at the ASX200 for 2020, it's the best performing market, whether you're looking in Aussie dollar terms or in another currency like US dollars. We're performing very nicely. The backdrop in global markets, as I talked about earlier in the week, continues to infuse. We've seen a trade deal coming through in the US. People saying, well, actually, do you know what? This is just a minor blip. The idea is that they're not actually seeing any kind of real meat on the bone. The tariffs are not being rolled back this year. We're going to see a sign where the US want to actually see these being adhered to before they roll back the tariffs, and then we can start talking about phase two. Any kind of dents to global economics are going to continue from that, but we are seeing low volatility, and markets shrug off pretty much any piece of bad news. We're not getting a lot of bad news, but when we do, it's shrugged off very quickly. If you have a look at implied volatility in the equity market, you've got the VIX trading around 12%. In the Treasury market, it's near sort of that sort of low 15 percentile. In the FX market, JP Morgan's Global FX Index, volatility index, is trading just shy of the 2014 and all-time lows that we've been seeing. So implied volatility in FX markets is very low indeed. No one really cares about anything that's going on. Look at dollar yen. I think it traded in a 21-point range yesterday, and that's what we're continuing to see. So the dynamics are liquidity, slightly better data, stability in the data flow. But if you have a look at real yields, they continue to not find any sellers really. In Australia, when you adjust the 10-year Australian government bond for inflation expectations, we're negative 24 basis points. Why are equities doing what they're doing in Australia? Well, we talked about those thematics, but where else do you go? Do you go into cash? No. Do you go into the bond market when yields on an inflation-adjusted basis are already negative? It's very difficult to do so. So in an environment with low volatility, equities continue to grind higher in that situation. Until those dynamics change, as I said before, this market's not going to see a big sell-off coming through. We talk about US elections. Obviously, we're talking at the moment about what's happening in the primaries. If we have a look at the TV debate that we saw yesterday, I think Bernie Sanders, I think Joe Biden, who continue to be the front runners in the market, I think they debated as well as some of the other candidates that are in there. But at the same time, I don't think they did their chances any damage at all whatsoever. So these markets continue to grind higher. The political events are not a concern for now. We're going to be having a look at those Iowa primaries on the 3rd of February. And traditionally, if you look over the last 6 elections, that has been been a rise for volatility in markets, but that's something we'll look at longer term. If we have a look at what's going on tonight, yeah, we've got US retail sales. The market's looking for 0.3 of an advanced level, 0.4 on that control group element. We've got Christine Lagarde speaking in Europe tonight. We've got jobless claims playing through. And we'll be keeping our eye on that pricing around what's happening in Bank of England pricing, where the market's pricing a 67% chance of a cut at the next meeting as well. And again, this idea that central banks, if they're going to move in a concerted and synchronised view towards dovish structure, and that continues to support risk in this market. So it's onwards and upwards for me for equities. It's hard to buy now. I certainly wouldn't be necessarily putting money to work, but until we see implied volatility kick up, if we start seeing political angst really playing through, people looking at liquidity dynamics changing, these markets are not going to find a heavy sell-off, with the exception of perhaps of profit taking.